Hi everyone, I've come here to do something that I hate, which is a quick sales pitch. On the 16th of January, Adam Lawrence and I are hosting our 5th property business workshop. If you've come to ones before, you'll know they are packed full of information for existing property business owners and portfolio holders. Normally, it's not the sexy stuff. It's the things that property business owners leave off or try and put to another day. But we get down to the nitty-gritty to help your property business scale. What we're going to be doing in January is focusing on productivity, looking at financial accounting and bookkeeping procedures to make sure that you understand all that data that's coming out of your business and how to act on it in terms of risks and opportunities and what are the metrics to track. As I said, it's the 16th of January. You can check out more information here. Please do come along. Tickets are selling out fast. And if you've been to one of them before, you will know that they're fantastic events, not just for the information, but also for the networking as well. They do sell out quickly. They're always sold out. So please, please, please click on that link and have a look and hopefully see you there.
Welcome to the Rodcast with Rod Turner, the show all about real estate. We discuss everything that affects asset-backed businesses, investments, and go deep into the details with some of the best in the business.
Today we've got an extra special guest in Ryan Etchells, the Chief Commercial Officer at Together Loans. Ryan, welcome. How are you?
Yeah, great. Thanks for having me. What's it to be here?
So Ryan, tell us, how did you become the Chief Commercial Officer at Together Loans, and what does a Chief Commercial Officer of, I think, the largest private lending company in the UK, certainly, what do they do day to day?
Yeah, I mean, I start with kind of how I got here, really. So my background is quite, working class. The area that I come from is very, very normal, very standard, north of England sort of town. And I didn't really kind of consider that I'd end up in financial services because I didn't really have that on the radar. It wasn't something that was an avenue that was available, really. And then I went to university and studied business, and I started thinking about kind of where to go next and graduate opportunities. And I met Together actually at a recruitment fair. And, I thought people that worked in financial services were from Oxford or Cambridge. I didn't realise, people like me could do that. And then I went along to Together's offices and as part of the process met quite a lot of the directors of the business, and particularly someone called Mark Goldberg, who a lot of people in the industry know really well. And I just remember looking and thinking, these people are just like me, they've got similar backgrounds to me, they work with common sense, they work on building relationships and having that kind of, that human interaction. And I thought, this is very similar to me and my background. And I thought, well, this kind of feels like the place for me. I love the culture. And, really kind of enjoyed my first few years there. I actually moved and did a bit of banking after the first few years of my career, and then took the opportunity to come back to Together after COVID in 2021. And, it's just a fascinating business. We're very, very focused on, as I said, relationships, very focused on talking to our customers, working with them as partners. Very focused on finding market niches that are maybe being unserved, which I find fascinating. And, coming from my background, a lot of the people that I grew up with were probably in some of those market niches and probably kind of struggling with access to finance. So it's something that's quite close to me. And then I've kind of rose to the role that I'm in now, Chief Commercial Officer. And the best way to describe that, as I always do, is I sit between raw materials. In our case, our raw materials is pound notes, and sales, and the people that go out there and sell the products. And therefore, so I and my teams, we build all the products, we price them, we put, the packaging on them, we do all the marketing, we do all the brand activity, we ensure we've got the right digital channels available. And I kind of connect raw materials with sales, which, I find really fulfilling.
What a great way of putting it. I love that, the link between raw materials and the sales arm. Yeah. So you mentioned products there.
Yes.
And Together is very well known for its specialist lending, so the specialist lending market. what is the specialist lending market? What is a specialist loan? Or how would you
Do you know,
describe
I
it?
could give some really highbrow answers here and talk about economics and geo kind of socioeconomics and everything, but the easiest way of saying it is specialist lenders exist to fill market niches and to meet customer needs that aren't being met elsewhere. And that can be in a lot of the markets that we operate in. Buy to let is a big market for us at the moment, and we're finding that there are market niches like, over the course of time, houses of multiple occupancy, holiday lets, these things that come to the market early and maybe aren't at a size that the banks can really approach it. That's where we come in, because we serve those needs, or maybe where banks are kind of restricting criteria and stepping away, and maybe changing their business models. That's where we find these gaps emerging. That's where we come in.
And why do you think, is it a case that those high street lenders and those kind of the big boys don't want to jump in because there's certain barriers that are put up? You mentioned things like, I don't know, HMOs or something is a good example. What is it that you think scares them or causes them to go, no, this isn't for us, until it's a bigger market maybe?
So, look, I always think back to kind of 2012 when mortgage market review happened, and a lot of the big banks and the challenger banks, they changed their business model as a result of that, and they've gone down the business model of ultra low cost, ultra fine margins, minimal touch points with the customer, minimal slick digital experience, and it works brilliantly. Not here to say that model doesn't work. It obviously works great. The financial service sector in our country is a massive part of our economy and serves customer needs really well. But the customer needs that model ends up serving is the kind of homogenized view of the world. The 70% of the country that equals kind of trillions and trillions of market that all the high street go chasing after. And again, it works really well. But what the specialist market does, and particularly together, what we do really well is that we aren't afraid of having sales teams that will have constant contact with our customers. We aren't afraid of specialist underwriters. Our underwriting teams and others in the specialist industry, they're so highly skilled because they can actually look at a deal.
Well, it's not tick box, is it? It's everything is going to be different. So I was going to say they must hate you because they're probably really, really busy doing something new.
For all that infrastructure, it adds cost to the business. And that I mentioned kind of raw materials and production, and our production costs are higher, and that's why we charge a higher rate. But it's that trust in having sales teams that will talk to customers, build relationships with customers, that underwriting team that can underwrite cases, the long forgotten art of underwriting. They're the things that allow us to operate in those market niches that require a lot more time, a lot more effort to understand cases, a lot more conversations with customers, and that's where we really play.
I think it's so interesting that you've mentioned the cost of getting to that point, because most people would have said, oh, it's risk and that's why we add some margin. But actually the risk is not the primary thing, because that's built into the loan to value, I guess, of what you do. So
absolutely, yeah. I mean, the best way I describe it as, and again, without being kind of the highbrow pieces, my wife is allergic to cow's milk. So we buy oat milk. Oat milk is a specialist product, but the raw materials for oat milk are more expensive, and the production costs of making the final product, it costs more. So it's a premium product, and therefore there's a premium price. Oat milk is about twice as expensive as cow's milk, but it's meeting a market need, it's meeting a customer need that can't be met elsewhere. And that's what we're great at. We're great at understanding those customer needs. We're great at understanding customer circumstances, and therefore we can provide a product that a lot of other lenders can't, and we're really proud of that. But we're a piece in the UK financing ecosystem. We're a piece in that puzzle, and again, we're really proud of that. You mentioned before, we're the largest specialist lender, and the market is becoming more and more in need of that.
Well, I was going to say the whole real estate investment market kind of is it's all specialist, because there's no one thing that's the same. I mean, you even go back to buy to let. I mean, buy to let's fairly new in itself.
Yeah.
And when you think about well, that seems very vanilla now, but actually that was once a specialist term,
Yeah.
isn't it? And so, well, I guess that brings me on to my next point, which is how, and you mentioned 2012 and the mortgage market review, and I'm just thinking, God, that was 12 years ago. Like, that's terrifying, isn't it? How would you say the specialist mortgage market has changed over the last, I don't know, 2 decades?
So I think there's two things going on. I've already talked about the business models of other people in our area have changed, and that's meant that there's been more and more customers that have fell out of that one size fits all model. But then another thing's happened, which is that the way the UK lives and works has been changing, especially over the last 5 years. We're seeing the UK economy and the socio-demographic nature of people is massively changing. So even recently, I saw a stat that said that there are now 1 million people over the age of 60 that are self-employed. Unbelievable statistic when you actually stand back and think about it. But the way that people are living and working is changing. So, you've got a lot of people now that are self-employed, as I've mentioned. You've got a lot of 0 hours contracts, a lot of gig economy are coming up, a lot of, people working multiple jobs. All those things that are changing with customers are all characteristics that it's not easy to just put in a computer and press a button and it comes out the other side. So not just the landscape, changing and restricting the way that they do things. The actual population in this country is changing, and it's got a massive demand for our products.
And so it's demand that's changed, and that then dictates what the products are, I guess.
I think so, yeah. So, back in the early 2010s, because of the way that the 2000s developed, there's a lot more credit in the market. And so back in the 2010s, specialist lending was quite a lot of adverse credit, quite a lot of credit impaired. And that still exists, there's still customers out there that need support with, if they've had a credit blip, looking forward, absolutely, there's still a little bit of that out there. But over the past 15 years, it's really changed now, and it's much more focused on, like you say, asset types, commercial property. Buy-to-let has become much more mainstream, but there's segments of that, particularly portfolio landlords. And that change is going to happen again over the next few years, changes to the prudential regulation that's changing now, Basel 3.1. It's going to make things much more homogenized in that space, and we think there's a massive opportunity for lenders like us again to just work with customers, build relationships with customers, and really understand the circumstances and help them achieve their ambitions by being there as their partner to support them.
Because for me, I was focused on development, and what really changed what I did was the rental stress test rules changing. That just changed everything, because suddenly I needed to go, right, how am I going to pay back senior debt? How am I going to refinance that? And that was really on that rental stress test, which made a massive difference to just how we operated as a business. Have there been any other things? I mean, obviously you've got things like 2008, and we'd mentioned demands change, and that kind of changes what the products that are coming out are. But also, how does the overall market of credit change? Because there was a massive liquidity issue during 2008. At the moment, or certainly since, I guess, 2012 probably, that hasn't been the case. There's been lots of money wanting to find a home, and certainly after COVID there seems to be a lot more.
Yeah.
Has there been anything in the market in general that you think has made big changes to
I
home?
think the whole UK got so comfortable with that period. We had 10 years of 0.1% base rate or 0.25%. Everybody got used to that and set the watches to that. What we've been through over the past 2 years with this base rate environment, and I genuinely think it's once in a generation what we've been through. I know we've had higher base rates in the past, but that kind of lobster in a boiling pot of every other month base rate rise.
Well, it's the velocity, it's the speed at which it went up. Because I mean, the difference in 0.1% and 5% is 3,000% or whatever it is. But but the difference, people go, well, 1989 it was 16%. Yeah, it only went from 14% to 16%. That's not a big increase. So
that's exactly right. it's been a once in a generation, period over this past 2 years, and customers have had to adjust to that. We've been working really closely with our buy-to-let customers, our commercial customers, our bridging customers to help them adjust through that period. And it feels like, as we head out of 2024 into 2025, it feels like that adjustment has now happened, and we're finding that particularly the property investors and the more mature ones and the more professional ones, they're now seeing it as an opportunity because they're seeing that other buy-to-let landlords are trying to exit the market with SDLT changes and inherit tax changes and all that sort of stuff. So you're finding now a class of investor that is really exploiting the opportunities that are presented, but those are the investors that are generally more complex. Those are the investors that generally need a little bit more understanding and a little bit more of a relationship focus. So again, that move and that shift of people into the specialist market, you can see it all the time.
And that kind of goes back to my point of the whole market is now almost specialist in my view. And interesting that you said about landlords leaving and other landlords, because for me these are just barriers to entry coming up. And what a great opportunity to pick up market share for those people that are in it and want to stay in it.
This won't play out in the data, but I have this theory that you had your property investors that had developed during the 2010s that had kind of took a couple of properties on as a pension. Though we saw that a lot. And then you'd find, and again, I've not got the data that proves this, but you'd find that, say, 5% of the market got to retirement age every year and they dispose of their assets and they go and take the lump sum and use it for the pension. What happened is that with the taxation changes and the penalisation on people that are holding it in soul's names, and then with the interest rate changes that were happening, I think in 2022-23, instead of seeing 5% of the market exiting, we saw more like 20%. Because you saw people at like 55-year-old thinking, well, I'm not going to wait till I'm 60. I'll get out now because the next 5 years doesn't look great if you're holding it in a personal name. So then what you've seen, and we've seen it in bridging on an unbelievable basis, the bridging market has been absolutely thriving in the past 2 years, which has been finding the professional investors, the ones that are in it more as a business.
As a living, yeah.
As a living. You found those, willfully transacting with those buy-to-let landlords that are
because they've got the right structures and setups. So
right structures, yeah. And there's one thing that's not changing: it's the demand for the rental property.
Well, it is. It's gone up.
It's unbelievable. I was something the other day from Foxtons, I think it was, that said for every rental they put on the market, they get 20 people queuing around the block to try and obtain.
I'm surprised it's not far more than that, to be honest.
So that demand isn't changing. And until we sort the supply side out of the housing,
it won't happen in our lifetime, is it?
It's looking really attractive now. Like, even though, we've got this change to SDLT that came in, which came in kind of overnight, which was lovely. And even though we saw that, the appetite for buy to let over this next few years is going to be really strong. I think we did some research recently that said that we're expecting rental income to kind of go up about 17% over the next few years, and asset values about 20% over the next 5 years. So that demand is still there, and therefore we're still seeing an attractive buy-to-let market.
Well, I've got a good stat for you that actually I released this morning, which is in the 8 years since 2014 when George Osborne changed the tax rules, the increase in new private property, private rented property, was 3.6%. Do you know what the increase was in the 8 years before that? 75%. So that has really dampened demand. So you have lots of landlords leaving, but they were the landlords that probably didn't have a huge amount of units. And the build to rent guys, they're not quick enough getting it up on the ground. So there's this huge period where you've got a real state. And during that time, although the net number or the nominal number of units is going up, the context isn't being given that, household formations is rocketing up. So we've got 200 plus households being formed every year. And
it's that's the fundamental problem that needs to be addressed I think we'll all agree on is the supply side of housing is just not there. I think the government has had an ambition to build 300,000 houses a year now for probably 10 years. I don't know if it's 10 years, but it feels like 10 years they've been saying 300,000 houses, 300,000 houses. I think the maximum they've ever built is about 1.8.
Well, I think the maximum was I think it was in the 70s, where they got it up to about 400 and something. But obviously we know what happened in the 70s, where there was zero red tape. Let's get these blocks up nice and quick. But look, it did a job. But I mean, yeah, they haven't got it near 300,000. And now the government's sort of saying, well, this 1.5 million that has this arbitrary number, oh no, that's at the end of the term. So because they know we're not going to make 300. I mean, they're not going to do 300 any year. But the point is, even if they did do the 1.5 million, but by that point in time, we've got more household formations. And so actually, well, that number by that point needs to be much bigger.
Exactly. And that's why we see a lot of opportunity, obviously, in the property market over the next few years, because that supply side of the equation isn't going to be solved anytime soon. So you're still going to have families, to your point, new formation of families. You're still going to have a lot of demand on housing, whether that be to live in, whether that's to purchase or to rent. That is not abating anytime soon. So we see a lot of growth in the market, in the property market over the next few years. We see a lot of opportunities for professional investors. We see a lot of opportunities for people to, really, really provide good quality housing for customers, which is massively needed.
And so going back to pricing of specialist mortgage products, how has the pricing, talk to me about kind of how the pricing has been done over the past, 20 years. How's that changed? Because obviously everyone's aware of Bank of England base rates moving, but how's that affected the actual product pricing?
So I guess the first thing to say is that, you touched on it earlier, specialist lending and specialist markets have been growing and growing and growing and will continue to do so. So a lot of specialist mortgage loan books have become much more attractive to investors. So, probably back in the 70s and 80s, it was generally bond finance, and now the mortgage books that Together and other specialist lenders are producing are much more investment grade.
Well, they're robust, aren't they? Yeah, it's a fixed income.
Yeah. So if I look at them versus now, the cost of our funding has become cheaper over time because people have, got more confidence in the specialist market. We've led the way with that. Absolutely. We're building that confidence. So you find that, if I think back to the 80s and 90s, the pricing of specialist versus high street has become tighter. There's no question about that. Which is obviously a great thing for customers. Over the past couple of years, the challenge has been reacting to that base rate environment. I said it before, there's a generation, including myself, of people that I started my job in August 2007. Base rate dropped down to 0.25 in about March 2008, was it? Something like that. So I've been used to all my working career, this rate environment. It took a lot of that new generation of people that are working in this market to get our heads around what that base rate environment means for lending. So it took us a little bit to get to grips with it. But now, we're pricing using the swap curve, using what we think, look forward, a Bank of England looks like. We're obviously hedging our loan books a lot better. So it's becoming much more scientific in how we do it, and again, that benefits the customers.
Yeah, absolutely, and that's really interesting, because I think when we think of kind of how the lending market works, everyone, well, like you say, since 2008, we've had these minuscule rates, and so these lenders everyone assumes, right, okay, lenders just make their money from getting this cheap finance and then making a margin on top. But now, what's happened is a lot of people have forgotten that before that, banks took deposits and actually made some money from people putting deposits in and making a margin. So if they gave savers 4% and then lend it out at 5%, that's a 25 or 20% margin, which is pretty nice. And so how is that now coming back? Are you seeing that? I don't think you're a deposit-led lender at all, but are we now seeing some banks, and this is why kind of you're seeing swaps that are far lower, and mortgage products, especially for homeowners, owner-occupiers. I know it's not something I don't think it's something you guys do, but we're seeing those lower than the Bank of England base rate, which obviously shows that it's not just about the swap curve, and actually there are some lenders that are making decent margins. But then you've also got some banks that have given these fantastic savings products out and now gone, oh God. Now the market's come, so they're desperately trying to lower those rates, and it's why you get these sneaky emails every couple of months from HSBC telling you your savings rate's gone down far lower than actually the base rate has reduced.
Yes, I mean the first thing we do resi mortgages. You know, we have got a great proposition for, you know, again, specialists, working in those segments that maybe are a bit disenfranchised. But look, as you say, we're not a deposit taker. You know, we source our finance from the money market, so it's a little bit clearer for us. But you know, I've worked in a bank. You know, I've worked in a couple of different banks, and that is the headache you're always facing. You know, you sit in asset liability committees, and you're always trying to balance that deposits versus lending. And it's not easy. You know, I know there's been some criticism over the past couple of years as base rates been rising, has savings rates been lagging behind, as the margin growing. But you exit in a period where, you know, we're always used to this 0.1. You know, it was, you know, relatively benign. Managing through that period and now looking forward, it's not an easy thing for banks to do, and I think banks are very conscious to be building resilient balance sheets. You know, we're still in a very uncertain time. There's a lot of geopolitical challenges, you know, in Europe, and now with Trump coming in, you know, there's still a lot of uncertainty. So savings rates tend to lag behind a little bit in terms of lending rates, understandably, but I think we should be conscious that banks have got to respond to those economic environments, and they probably are building a little bit of resilience, because you never know where the next.
And that's actually something that I think UK lending market has done quite well after sort of the GFC, when it's like America might not have done so well, but is putting things in place to protect that. And we moan about it, but actually it's a good thing because there's resilience in that the market as well.
Yeah, absolutely. I think the way the UK market learned lessons from the financial crisis is very impressive. So you think about the current situation we find ourselves in, where base rate has risen substantially, and you know, people are rolling off mortgage rates of 2% and rolling off onto variable rates of 7% and looking to refix. You know, it's not an easy thing for customers to deal with that. So I think the way that the lending sector, you know, on the whole, is managing customers through that challenge, because it's not just a mortgage rate challenge. It's they've had energy prices that have been going up. They've had cost of groceries going up. You know, people have been hit with quite a lot over this few years since COVID. And I think the lessons that the lending sector learned from GFC are really coming to the front now. And you're seeing that obviously there's cases which, you know, individual customer cases and cohorts of customers that will undoubtedly be feeling some strain, and you know, lenders will work with them. But as a whole, the way that banks are working with customers through what is a once in a generational challenge, I think is really, really good. And again, is a testament to lessons that we'll learn coming out of the GFC, which, you know, the GFC wasn't all the UK's fault. There was a lot of external forces on that, but I think the way that we responded to it as a financial services sector is really commendable.
Yeah, no, I totally agree with that. There is so much in that answer that I want to kind of jump onto. So we got Trump, which I'm going to come back to. We've got a few other bits in terms of customers getting used to that pricing jumping up by a massive bit. But before we go on to those bits, pricing, going back to that, how do you think the specialist mortgage product pricing now has changed in terms of the spread between maybe your typical base rate or your typical swap rate, over the years. So if we kind of go back 5 years, you might have had swap rates at, I don't know, I'll be wrong on this, but as an example, say 3%, and then products might have been going out the door, including your fee, at, I don't know, 5%, say. That difference between 3 and 5%, again, my maths probably isn't good enough, but I think is around 40% difference. Yeah. Now we seem to be seeing, right, okay, we've got the swap rates at about, I don't know, God knows what it is today, but four-ish, 4.5. And we're seeing that I don't know, it might be 7%. With your fee, it might kind of work out as 8% on a specialist product. Now that sounds like it's a big jump. Like, is that right? Is there a difference there? Is there anything that kind of we can take from that?
So I think my view is that we'll probably have got ourselves back to where it was in the specialist sector.
Yeah.
I think, you know, if I think about kind of our residential proposition, you know, pre 2022, you probably find yourself in a comparable position now as to where we were then. I think the challenge has been through the period where base rate's been moving. I think it's been pinning the tail on the donkey a little bit. So I think back to the trust scenario. I mean, I was actually away when that budget happened on I think it was a Thursday. It happened on the Friday. I think it was a Friday. I was actually out the country and I kind of saw the budget and I thought, oh, that looks interesting. But didn't think too much of it. And I came back into work on the Monday and swap rates were just blowing up. You couldn't figure out what was going on. So we had to pull all our products off the market like everyone else in the sector.
Yeah.
Massive decision to do that. But that was in response to, we've got no confidence in what we're going to hedge in our loan book. So I can't be in the market. So coming out of that, we became more reserved. We became more conservative with our pricing. So, you know,
but there it was, risk was entering into it. Yeah,
absolutely. But a different sort of risk. Not a credit risk, more of a financial performance risk. So, you know, if you looked at that kind of view over a few years, during that period, there probably was times when our margin was widening because you didn't have confidence in how you was hedging your loan book. But I think if you look at today, where we've got more confidence in the position, it's much more stable. Sorry, I should say, yeah. And you know, swap rates are moving on a month-by-month basis of like 10 bips to any episode, so you get a lot more confidence in it. So today versus pre kind of 2022, you're probably seeing the same sort of pricing spread. But during that period, there'll have been times when we was way out the wrong way. And putting products out there that will effectively sit on the books not making money. And there's probably times when we was making a little bit excess because we was a little bit more concerned about swap rates. But all in all, I think we balanced through that. And that kind of comes back to my earlier point. You know, we've been through a period where there's a new generation now of lenders, new generation of people working in the financial services sector that have been used to, you know, I'm 40-year-old now, and all I've ever known is that 0.1 base rate environment. Yeah. So it's been an adjustment for everyone in the sector just to get their heads around what it means. And you know, I think broadly we've managed to do it really well. Most important bit is being there for customers. You know, that's the bit that's really key. That, you know, as they've been experiencing these challenges, as they've been kind of working through what that means for them, being there to support them, doubling down on those relationships has been the key.
No, I think that's a really well explained kind of way of doing it. So yeah, really interesting to hear that. Staying on that kind of pricing scenario, what we've seen certainly over the past few years and since Trust's kind of budget time is product fees ramp up. So rather than the interest rates, the product fee ramp up, and that's really been down to kind of the stress tests, I guess. So when people are coming off 70-75% loan to value, in order to be able to get that back and be able to repay the lender, adding those product fees and reducing that has been something that we've seen the whole market do. Couple of points on that. The first one being, is that not a loan to value concern, because a lot of those product fees are added to the loan, so suddenly a 70% loan to value might turn into 75 and things like that. So are lenders worried about that? And then the other point is, as things have stabilised, are you expecting those high product fees to remain, or do you think they'll come off, or will it be actually it'll be interest rates that reduce, but the product fees might stay?
Do you know what? I think it's the response of the market was a necessity.
Yeah.
You've kind of described that. You had, particularly on the buy-to-let side. It didn't really happen on the residential side because the customer need wasn't there as much. But on the buy-to-let side, we saw that, and I think the market responded quite innovatively to say, look, we'll provide the right solution for you. Again, coming back to that customer need point.
No, I thought that was genius, to be honest. Yeah.
So we've got propositions out there now with our kind of normal fee, and then we've got 2 higher fees and the lower rate to try and keep the pay rate, at the right level for the customer. I think that's born out of necessity. I think that's here to stay, because I think it provides a real flexibility for the customer. Now, obviously, what we do, you kind of touched on it, is at those higher fee levels, we're bringing the LTV down for those products. So we cap out 70%, for example, where it's one of them higher fee products. Because you're right, you don't want to creep in.
No, exactly.
And find,
because you're kind of kicking
boiling pot.
You're kicking the can down the road a bit, aren't you? Yeah.
But particularly for a customer that's thinking to themselves, I maybe want to keep this investment for another few years, and then I'll probably look into dispose. It works really well for them because they can use a bit of their equity, keep the pay rate low, keep the tenant in the property, and keep the tenant in the right position that they want to be in. So it's worked, again, born out of necessity. That innovation has worked really well and supported a lot of customers through a challenge. And again, that point again about supporting customers, having that relationship, this has been a part of that, I think, for Together and the whole market. But I do think it will stick around because I think that customers have recognised that optionality is really useful.
Yeah. No, I totally agree with that. Yeah.
Especially on the commercial side as well. On the commercial lending side, where you do tend to find that the initial lend is at a very conservative LTV. If they are looking to remon, there's a real good reason as to why they're doing it. Works really well. So yeah, I think it'll stick around. And I think, the customers, again, particularly in the specialist sector, they tend to be quite sophisticated. They tend to have really good, understanding of the options that are available to them. It works really well to present those options and have that conversation with the customer.
No, and look, options is always a great thing, isn't it? If you're giving customers choices, it's fantastic. Interesting. So going then back onto, you mentioned kind of customers getting their heads around, right, I'm going from a 3% loan onto a 7% loan or something like that. One of the things I think that's quite different about the UK market now than it was in 2008 and certainly in like 1989, 1990 when we had another big crash is the amount of equity in it. I think it's something like we've got about 8 trillion is the value of residential property, and the amount of debt is under 2. So it's a really like low loan to value. I think, again, don't quote me on the stats, but it's something like only 33% of the total of residential properties have a mortgage, and of those, the loan to value is quite low. With that said, we are still seeing about 5 to 7% of that market who does have mortgages coming to the end of their fixed rate terms, because, again, unlike those other periods, 80% of loans are on fixed rate terms now rather than variable. So you're seeing about 400,000 people suddenly every year going, oh, now it's my turn. I'm jumping from my 2% Halifax mortgage up to 4%, which is a doubling of your interest every month, which is going to hurt. It's going to hurt everyone.
Yeah, I mean,
but is it enough to move the needle? Is it enough to move the needle on pricing?
Yeah, so I mean, obviously, I'm someone that experienced that same thing. I have a mortgage, and that roll off of your fixed rate wasn't a nice calendar month, to say the least. And we're all jealous of them people you meet down the pub, and they say, "Oh, I got a 5-year fix in September 2021," and you go, "Oh, did you know it?" But look, we've all experienced it. It's the economic challenge we've all been facing, and the Bank of England grapple with that on a monthly basis, I'm sure. So, we have obviously seen that, and to your point, we're still seeing that roll-off happen. We've seen quite a lot, autumn 2021 when the SDLT holiday ended, and base rates started moving up. We've seen the people that were in 2-year fixes, a big rump of those have now rolled off. So you've seen that there's still people in 5-year. And we are still seeing, to your point, at the macro level in the UK economy, we're still seeing, I think you said between 4 and 7% roll.
5 and 7, I
Yeah,
think
5
it
and
is. Yeah.
So you're still seeing that roll off.
But like you say, there's not many left. The kind of coming to the end of that
Seeing the
phase.
big rump of
Yeah.
it, yeah. Which is why I think we're now seeing a lot more activity in the market, a lot more for sale signs up, a lot more skips on driveways, because you're seeing people have rolled off, they've become accustomed to the new rate, and they're thinking, all right, okay, well, if I'm going to fix into a new deal, I might as well move to the house I want to move, or I might as well do something to my property. So you're seeing that all settle down. But the fundamental point to me is, again, coming back to earlier on, I think what you were saying was, if people are now paying higher rates and that maybe puts them off moving house, does that then have a counteractive impact on house prices? I think where he was getting at. So I guess the first point is, we do still see that demand. We do see that, right move numbers are all moving up, mortgage applications are moving up, mortgage completions are moving up. So we aren't really seeing that demand tail off. But I do genuinely think the reason being is that no matter how much customers are rolling off, the supply side of the equation is not getting solved. And,
And wages are moving up.
And wages are moving up as well. But that gap of houses being built, we find ourselves in a really peculiar environment where government now lobby the big house builders to please build some houses, rather than the other way around, like people lobbying the government lobby house builders. But the big house builders, they will contribute the units that they'll contribute, and they will build on the land that we want to build on. The bit that we need to unlock, I think, are the SME house builders. The SME house builders that are building 50 to 100 units, the ones that, will opportunistically find plots of land that need developing. They will do the hard yards of getting that planning permission. They'll work with a lender to manage them through that process, and they will build. That's where that's where I think the delta is going to come from, those SME house builders.
Well, I've got a great graph that shows who's built houses over the last 100 years, and the first sort of half of that is, or first sort of 60-70%, is very much that SME market and local authorities. And then up to about 1980, 1990, it's gone right down. Local authorities is a terrifying number. It's kind of in the tens of thousands now. And same with SMEs. And actually, they used to be a real big chunk of that market. And I totally agree with you. Government or regulators need to use the carrot rather than the stick and really encourage.
And when you sit down, I was out for a meal the other night with a house builder that we work with and we've supported over the course of, it must be 15 years now. When you sit down and talk to them, they're the ones that actually, they've got the bit between the ears on this. They've got the thinking power, but they just need the support. They need help with planning reform. I know it's been said 50,000 times, and it was great to see it at the centre of the King's speech with the new government, but let's see if it comes forward. We need that planning reform. We need to support these SME house builders with access to finance, which again is something that we do a lot of. We do fund a lot of developers, a lot of those SME developers, a lot of those people that are really trying to unlock some of those opportunities in the market.
Wouldn't it be nice if Homes England actually lent some of that money they got on the big file to SMEs? Don't should we have it in the Yeah. Oh, brilliant. Look, okay, so you mentioned Trump, and we've also had a new government in here, and we've seen markets respond to the latest budget from Rachel Reeves, and then we've had Trump come in and start talking, and again it's just talk at the moment, but about restrictions on trade and with the UK. All these things have inflationary pressure. So just when we were starting to see a reduction in kind of swaps, these two things have come and started pushing it right back up again. What are your thoughts on that for the next few years? Do you think the inflationary pressure is still there, keeping those kind of swap rates up?
So it seems to be, is the honest answer. I mean, it might not age well, this, but over the past, since the budget, we've seen swap rates drift up about, kind of started just before the budget actually, obviously as things were getting leaked, but we've seen swap rates drift up about 20-25 bips on the 5-year, which indicates the market thinks that we'll probably get to a reasonably the same base rate number as we thought previously, but it'll be much more slower. It'll be a shallower curve to get us back down to that. So we're definitely seeing that reaction coming out of the budget. I think the markets are still digesting what an incoming Trump government's going to do. And
well, he's a bit volatile. No one knows what's going.
Look, I'm not qualified to sit here and have a view on how that's going to feed its way through, but listening to the mood music from the Bank of England, coming out of the latest MPC, they're definitely making sure the markets understand, look, this isn't going to be a base rate cut every time we meet. You know, it's probably going to be every other time we meet. And that's the kind of indication they give it, and you can see that in the swap rates.
And I think half of their job really is managing expectations as well. And like you say, it's the words they use rather than the actions they do, which is hopefully going to manage the market so that they don't have to make drastic sort of.
Was it
It was Mark Carney with forward guidance, wasn't it?
Yeah. But he's right though. You know, you've got to give more confidence to the markets. You see what happens when you surprise the markets with something. With the trust budget, which I know that she still defends, but the fact is she surprised the markets and they didn't know how to react, and therefore it became very volatile.
That is exactly it. And people talk about kind of reform getting in, and they say a lot of things which I don't think is based on them getting in, it's just to get votes for the next time. But one of the things is, it's like, well, you can say whatever you like, but if you don't price how you're going to do it, markets will be terrified. And that was the problem there. At least with this government, they have come up with how they're going to price it with taxes, which people obviously aren't going to like. But that's why it's been treated so much better than the one before. And so, you're absolutely right. They need to let people understand how it's going to work.
And to kind of to your point, though, that I'm with you on all that. And to your point, kind of the unknown of Trump, I guess, is the bit that markets aren't really digesting at the moment. So let's see how the next couple of pegs itself out. It is exciting stuff. But look, I was saying, we had a call this morning. We had a bit of a call with all our sales teams this morning, and we have a bit of an internal economist that probably economist 2 grand level, where he's probably sat blushing now listening to this. But he looks at markets and he understands and digests what things are being said. And the fact is, for our UK economy and for the property market, 2025 is going to be a strong year. You can already start to see that now. I think Q1 will be a rush to buy before the stamp duty changes for residential homeowners. But
transactions are going to start shooting, and that's a good thing. Yeah,
great thing. You know, people getting into the properties they want to live in. But as we move through next year, we think there's a lot of growth in our markets. So, you know, we're readying ourselves for that. As is, you know, a lot of the lending market is getting ready to support customers through. Again, we think a lot of optimism going into 2025.
And look, you've come today with this your residential property market report. So where can people find this? And have a good.
So look, best place to go is on the website, or we've got social posts that have got it in there. But look, this is one thing that we think the market really needs, is that, you know, there's a lot of commentary in the market. There's a lot of data-led housing price index, etc. But what we want to do is talk to customers about what we think that means. So not the data as it in its raw format, but what do we think that means? Where do we think opportunities are? So our residential property report doesn't just talk about the trends in the market. It talks about, so what do we think that
was? How do you act on it? How do you act? Yeah.
And how do you, you know, as someone that we want to talk to, as someone we want to build relationships with, like, how do we think you should exploit the opportunities that are available?
Fantastic. We'll make sure we put a link to that in the show notes.
Yep.
Ryan, it's been an absolute pleasure speaking to you today. Like I said before, you've got a real knack for explaining quite complex things in a really kind of easy to understand way. So thank you for that, and I'm sure the listeners will agree. And even more of a thanks for this lovely Christmas present that Ryan's bought. And he did tell me that the Cadbury's have nicked the Together kind of branding, haven't they, in the colours? So well,
I think we were established before then. Don't know. I don't know their foundation date, but but no, it's just something that we like to give people that we like working with.
Oh, brilliant! Well, thank you. There you go. It'll go far. Brilliant. Thanks so much for coming in. Hope we can do it again.
Yeah,
cheers.
Great. Thank you.